Hello, welcome everyone. John Person here. It is Wednesday and it is August 10th. It's 4:16 in the afternoon. Market is now closed. Couple things of note. The S&Ps did form a daily low close doji in the cash S&P Spider ETF. Right here is the doji from the prior day. Here's a considered a little low close doji. In the breadth advanced decline, we did have a consecutive, a little divergence going on here. As you can see, we've got a little what might be called a broadening top pattern. Of course, in a larger scale, this is another kind of broadening top pattern here that keeps on broadening itself out to new horizons. But when we're looking to see if the market is actually getting weakness, we would probably look for the breadth. Right now, we just have a consecutive series of lower highs, but not lower lows. So we don't have a downtrend intact. Volume is still, questionably hasn't gone anywhere. So it really, the market's been rallying what looked like to be some decent volume over the last couple days. As you can see, it just hasn't seen the follow through. What does that all mean? Well, my indicator is got a little bit of, this is a volume indicator here. It is showing divergence. So perhaps this is the 11-week cycle due date for the high of the market, which, give or take a week early, a week late, somewhere in here, we see the markets tend to peak out. And I think that at this point in time, we have still a shot that we got a market that can make one more move up first. I would be on guard for breaks below, or breaks meaning a close below two levels, two line in the sands. One, I want to see the market close below the moving average. Two, I want to see the market if it closes below Friday's low. That would be a very important milestone to see it close below Friday's low. And if the condition of that low comes at the expense of a further erosion in breadth and on heightened volume, then I'm at that point in time going to say that very easily we could get back into this zone in the market, and that's kind of what I'm looking at. So from a risk reward perspective, let's examine this real quick. The market could get up to the 219, 220 area, and from current prices at around 218, that leaves this to be the kind of the potential reward. If the market gives us that correction going into the September-October time period, and we only get back to like 209, 210, let's call it, into that zone, this is the potential reward. So if you can kind of take a look at this being the reward, if it fills in that level, you're risking this to be long to make maybe that. Now, short-term traders, you just can't load the boat to the short side quite yet, but there's a lot of stocks here that I think that we're going to go over, which I did this morning, and I wanted to review them, which is causing certainly a longer term, intermediate term, 6-8 weeks out, cause for caution and concern. With that said, several weeks ago, I did or actually 2 weeks ago, we did a PowerPoint presentation. Many of you were probably there. I know I tweeted this picture out. I talked about it. I emailed it, and I put it in, I believe, if I get my notes out, I think it was in the August 1st. It was in the August 1st Weekly Thoughts issue about the trader that did the ratio call spread, where they sold two out of the money call spreads. It was the 220, 222 strikes, and then they bought just one of the 117.5, 119.5, and they did that at even money. So if the market does nothing, then guess what they do? They break even. They didn't cost them any money to do the trade. However, if the market goes up, they're going to make money using the market's money to finance their trade, not their own. So here's the actual slide, and I wanted to bring it into your attention because they did this, I believe, 100,000 times. So if you can see here, here's the 217 strike. They did this 100,000 times. Here is the 219.5 strike. They did that 100,000. So this is actually the trade right there. Then, if you note here, a next strike price, which was the 220s. There's 200,000 there, and then go up the chain here, and you notice at 222, there's 210. So pretty darn close. So maybe there's a little bit off balance here or there, a few thousand. But the moral of the story, if you're short the 220, long the 222, and you do that twice, 200,000, and then you're long the 17 and a half, short the 19 and a half, 100,000 times. And if you do this side at 80 cents and you do this side at 40 cents, but you do that times 2, right? Apart from your cost of doing business, commissions, you have a zero cost factor money down strategy. So anything above 217 and a half is profit for this trader. So I imagine what they're looking at, their maximum, if you think about it, the maximum profit here would be from 217 and a half net free and clear all the way up to about that 220 level. So that's $250 per option times 100,000, right? Anything above 221 and I think a quarter is the break even. And of course, their maximum risk on the strategy is anything above 222, the trader loses $150. So it's a good risk reward ratio and high probability. We called that, at the time. I said, man, this is a smart trade. It's a really clean, neat trade, playing theta, playing deltas, playing the whole gamut, and trying to target the market up at a specific level by the August expiration, which is now in 10 days. So what does all of that really mean? Well, quite frankly, we have a quarterly pivot resistance targeted at around the 219 area. We put that in the weekly thoughts and observations, and there's still a shot we can get there. So if the weekly cycles due this week, we still don't have sell signals. We have a mixed board across the market. When I say a mixed board, first and foremost, let's look at today's price action. Crude oil's down. IBB, drug stocks down. We did a strategy yesterday for $1 in the XLV. It was a 4-wide 75-71 vertical bear put spread for $1. And today we sent out an email alert to, if you wanted to take a quick 25% profit overnight, I mean literally put the trade on yesterday, thing was up, you could have gotten out, and some people did, I think, at around 25 for $1.25. The most that you can make on that, if it's a 4 wide and you pay $1, 4 minus 1 is 3. So over the next 44 days, $3 is the most you can make. And if you can do $25 rather than $300 in less than 24 hours, you can shape some off. And then, that way it almost comes out to be like a free trade. You're using the market, and now you just got a free trade on. And then we'll reevaluate. Let's take a gander at just some of the other kind of trades that we did have yesterday. Because of an earnings report, I decided Fossil, particularly, as I explained, I wasn't too keen on taking Tiffany's in on sympathy risk of this particular stock. So Fossil came out, beat, gaps higher open, trades back down. I mean, crazy markets. These are kind of crazy markets. And Tiffany, again, was the stock that, as I sent the email alert out, and by the time you guys got your email, you should have been out of the trade at 63.68. And we settled today, no harm, no foul, at 67. I'm not chasing the market. I want to see how it really behaves. So that was kind of a little godsend. Next, we actually, because of, and I wrote about this and I talked about this with Marathon Petroleum, one of the things that I did not like about Marathon MPC was the fact that the volume was starting to decline as the price moved up. So we put the pull the plug type order there and liquidated Marathon Pete in at 39.13, out at 41.11. Today, it opened, it traded higher, and what did it do? It closed lower than our exit. So clean and simple, easy peasy. Now, we hung on to Valero, and people would say, well, why did you do that? And real simple, the volume actually looks a lot better. The volume's going up, which is unique compared to the last chart, right? Whereas price was going up and volume's going down. So this actually kind of has, to me, the ability that it can sustain its momentum. We put out a trade action alert suggesting that if you were in this, that what you do is you raise your stop up. So it's a strong suggestion that lets people still participate in this particular market, but you need to take kind of proactive. Now, with the markets, we do always have that risk of gaps, but where this particular market and with our stop, I think it's fairly reasonable there. Okay. This week we kind of went with more stock positions, or we went with more weight on Hess, but with the way things were kind of trading and some volume, what we did is we said to cancel your orders in Hess, cancel stops, cancel everything that was suggested. And then now let's take a look at BOFI. Well, I don't like to get filled at the end of the week, or the middle of the week. I like to get filled on a lower open, say on Monday. The market give you a shot at maybe pulling back a little bit, get filled, and then have the market, move up with the trend. I certainly don't like having an order resting down below the market here when we're now back into a daily sell. The odds of this being a great trade have just diminished immensely. So with that said, the suggestion to be in BOFI holdings, and the symbol of course is BOFI, the suggestion there to be in at 1738, we got filled today. As you can see, it's at 1725. Our stop is 1673. Let's see if we do get that little resurgent to the upside and we get lucky on the upside. If we do, we will be suggesting to move your stops up to by the end of tomorrow. We'll see if we get a bounce up there. So we'll be monitoring this very carefully. All right, looking at the short strategies for a suggestion of this week's analysis, you will note that Monday, if you were looking at the short side or looking for high probability trends to tackle, a short was suggested at 74.18, and you had filled on Monday. Pretty neat trick because the high was 33, and then as you know, you're up just a little bit up, about a buck. We are coming into a little support, so this is one that I would actually jam the stop down to break even. We should start to see the market see some further erosion, but quite frankly, and I thought we would see, a little bit more heavier downside selling. Volume is fairly light, but my indicator, the volume indicator, is still showing negative volume path. So that's good to be on the short side, but I would certainly suggest to move stops to a little bit about break even in this environment right now. Two others on the short side that were some suggestions that we did was one, Kimberly-Clark, KMB. Kimberly-Clark, obviously it's not near the 131.02 level to get short. And I'm kind of not liking the fact that even though the weekly chart, if we go over here and change this real quick to the weekly pattern, I'm thinking, this was a doji, believe it or not. We did get a low close doji, and then we formed another doji. So I think what had happened is an example when running the scans. I think that, not sure what happened, to be honest with you, but because that clearly was a doji the other day, or when we did the advisory scans. But the divergence there in this volume, to me, longer term, might be detrimental. But at the end of a little move to the downside and I get dojis, I'm not too thrilled about. So why don't we just cancel the orders there, and then we'll take a look at, since we've missed the one in fifth serve, might as well just cancel those orders too. And you can leave them work if you want, but quite frankly, it's probably something that's not going to get filled. Here's the weekly chart on fifth serve. It's kind of like, I think as we're in the middle of the week, we'll probably have better trades coming up. And then look at today, we formed a doji. So how thrilling could that be with a gap above the market? I like to get filled immediately, take no heat, and then straight down. And, we'll just continue to look for those types of moves. And I think, or those opportunities, I think what it is that, the market having that kind of like quasi feeling that we could see short-term upside move. and get the spiders back up into the 219, 220 handle short term this week, next week, something like that. But then look like, the downside action to come after that. And I really do think we're going to see the downside action. And one of the reasons, as I promised, I want to show you a few names. So this is the concern. Short term, maybe we go a little bit higher. So what are we positioned for? We're positioned for the short side of some healthcare. We're positioned mildly with what? Spiders, vertical put spread. We have a small position on Valero. We dumped Tiffany for a scratch small profit, and we got out of Marathon Petroleum for a nice little profit. With that said, here's the concern, and a bunch of names that all have one common denominator amongst themselves. We just like Amazon right here. The market's rallying to new highs. You're kind of seeing maybe a potential, rising wedge formation. Look at the histogram. It's showing lower highs. And look at even my volume from this high to this old high. We have a divergence pattern formed on the weekly charts. So short term, sure, we could go up a little bit, get into 77, 75, something of that nature. But the way the market's starting to move up, when we were in the beginning trend of breaking out, we had larger ranges moving up. And as the market's moving up, you can notice that the open-close relationships starting to diminish. And that is indicative of a pattern called a rising wedge formation, normally found at the end of trends. I mean, there's the rising wedge formation. If this thing does get a rollover and break, I mean, we could get probably a move back into the, I'm guessing, 720 handle. So with the short-term wedge pattern, with the higher degree time frame divergence pattern, that's where I have one concern. That's just one. So let me share with you a few others that look very similar. GOOG, the behemoth, Google. So while the divergence isn't as pronounced, the volume is starting to get there. The volume of my indicator, my volume indicator is showing divergence, and that to me is a little bit scary. In addition, the short-term daily starting to show the momentum histogram as this move has taken us up, and it's been a nice little trend to the upside with Google. The longer-term pattern looks more indicative of a trading range. So a trading range with a weakening volume does not bode for me after having 1, 2, 3, 4, 5, 6. This would be the 7th week straight up, and that's pretty much a parabolic straight up move. Those types of moves, start to, after a period of move rallying, tends to make one a little hesitant of chasing a market. L3 communications. So if you just look with the weekly histogram right here and the weekly volume indicator, it's starting to look a little on the very similar type of pattern. And note that we have here a doji formation that was created last week. That's the weekly chart, not giving me a huge sense of getting aggressively long here. PCG, here's a little stock that had a huge run up. Another doji, very similar to the last chart we just saw. Momentum indicator is bearish, and volume indicator is flashing what? Divergence. Sherwin-Williams, divergence, divergence, volume flatlining, markets having a hard time staying up, making substantially higher highs, right? So this is another market that has my top side concerns. 3M, divergence, divergence, going through UTX, divergence, divergence. While it doesn't have as strong of a high that we saw in the other markets, it definitely, I'm looking at indicators only. The United Healthcare Group, UNH, widely held stock, starting to show some signs of tiredness. Look at the diminished ranges, open closes 4 weeks in a row. Volume is starting to diverge, and the histogram component of the momentum indicator is showing some divergence there. So that's a nice little warning shot as well. when we take a look at Cisco SYY, which is the in the consumer staples sector. It did form a weekly low close doji. It reversed it. It hasn't taken it out. But when I look at the volume, the only difference between this picture and the last few stocks that I shared with you is we do have the momentum histogram to the downside, but in the volume indicator, while the volume moving averages are higher, the histogram component is lower. So there is a little divergence there forming in Cisco. And in other food purveyor companies, Tyson, TSN. So TSN, here's I'm not sure if this is going to be 2 dojis in a row, but Tyson certainly is starting to see the volume, the momentum histogram show divergence. And look at my volume. The volume indicator is showing clearly divergences. So the higher this thing goes, and it is forming divergence on the volume indicator as well as my momentum indicator, it's warning us that while we could go up a little bit more in the short term, we have a strong risk. And what's a little further upside? I don't know, from current price, we could probably see another buck or so, half a dollar, for a potential $8 to $10 downside move. So to me, making $1 to the upside for a potential $10 to the downside is not my desire in this market environment. So there are a lot of concerns. Tyco Industries, you remember, this is a blast from the past. TYC. Tyco, same thing. Look at the momentum, the volume, look at the momentum. And I can go, I've got about 50 of these stocks, and I can just go on and on. Look at Allstate, momentum, volume, 2 different indicators doing 2 different things based on 2 different concepts. One's purely based on volume, one's purely based on price and the relationship to the moving averages. So, these are 2 indicators that are showing, even though Cisco, which, barely, gosh, from 20, it's like a preferred stock in financials. It barely moves. It's in a tight range, but it's widely held. From 23 to 30, a $7 range over the last 2 years is, to me, kind of a tight range. But, when you combine the different markets in the different areas, DG, Dollar General, when I combine these, I got to ask myself, why? There's just so many of these names that have the same consideration: volume divergence, histogram divergence after a huge uptrend. And I'm supposed to believe that the market is, got a long way to go, and now I'm supposed to, get people to invest in the market. Other stocks that we liked in other segments earlier this year, we were long. Caterpillar was one. Hopefully you guys remember that one. And while it does have a component of a little inverted head and shoulders bottom, which a lot of stocks, as we've been describing, have. Problem is the market's now rallied. There's no volume here. Look at the volume indicator and look at the histogram. So, regardless of what the price and where its relationship is to the last 52-week or 104-week 2-year high, I'm looking at divergence patterns within these 2 indicators only. And these 2 indicators are suggesting that there's divergence in the weekly charts building. So when there finally is a sell signal, don't be surprised to see a lot of these names come tumbling down. The one surprising stock that I've covered since probably April, right, has been Home Depot. And Home Depot, even on a longer term scale, as it made this high, and I remember we were in a trade, specifically the call spreads, right? We did a credit call spread. So we weren't looking for the market to crash and burn. All we were looking for was what? The market to kind of have a muted downside reaction. So this was an area that we got into a call spread in the marketplace. And then if you note here, what's going on with that volume, right? And then when you take a gander, besides looking at the volume, look at the histogram components. So now we've just made a new higher high after what might be construed as a triple top on lighter volume. Look at the on-balance volume. Look at the daily on-balance volume. If that's not divergence, I don't know what is, folks. So it's short term, it's intermediate term, it's a lot of names, and they're all coming into fruition. And these are not small companies by any stretch of the imagination. Last one, CMCSA, Comcast. How many times have we seen just the few names that I've brought to your attention that they all have another common denominator, a lot of dojis on the weekly charts. So while this isn't an actual significant bearish divergence, it's still divergence, and so is the volume, and so is the on-balance volume. So Comcast is one that's definitely, if we're going to see a market reversal to the downside, it's probably on the top of the shelf there. Look at Verizon. Now Verizon, it started to give, and this is the point that I wanted to make. So ahead of everyone wanting to be in telecoms, and we did see a nice little upside move here. All of a sudden, the warning was kind of on the scene where we had a higher high, but not in the momentum indicator. And then look at my volume indicator, indicating bearish divergence. I mean, obviously we have lower highs. So what happened? It started to stall, and then all of a sudden we started to chop around. We went from trend to what? Consolidation, and then we've broken down. This is kind of what I'm expecting with a lot of these names, because you're starting to see it occur early on some names. You can even go and look at a company like Bristol Myers. So how many of you would like me to have said, hey, by the way, guys, we've got Bristol Myers breaking up and making new highs, and as you can see, here's new highs, and something's going on because we're making new highs and the momentum indicator's not and the volume's not, is that it's a cause for concern. And you would probably say, oh, no, and then all of a sudden here we are at 60.58, and definitely cause for concern. So between, when I look at how do these indicators work, more times than not, they give us early warning. It's up to us to kind of trust them. And how do you want to trade? Do you want to prepare for, another $1, $2 in the upside in some stocks for a $10 decline? Everyone can trade both sides of the market, but there's a lot of warnings here. Kate Spade had bad reporting news, but this is a bad example because she was already in a downtrend. But let's take a look at some others that had some bad news. So earlier this year, we definitely had steel stocks pegged, and we were looking at Zeus, U.S. Steel. We tweeted it out. I remember being in the an APTA meeting here in Jupiter. APTA is the American Association of Professional Technical Analysts, and great organization. Like the hierarchy of the MTA, Market Technicians Association. And while in there, I know I was tweeting a lot of different names out that still looked incredibly bullish. But here's U.S. Steel, and it's just tearing off, and everyone's like, man, the steel stocks, it's not giving it up. Well, the momentum indicator did not give a bearish divergence, but after this whole time period of the reading in here, right, the reading at this point in time with price way up there, you'd expect the momentum indicator to be way the heck up here. What about volume? That last secondary high really came at an expense, and then what have we seen? A pullback. So while it's tough to time it exactly to the minute to the hour, it's a warning signal that and that's the tough part. Some people would still stay long, and some people would add to their longs, and then instead of scaling out and taking something off the table, when the volume and the momentum line up, and that's the key. When those two indicators line up, and that's what I was sharing with you, we got a lot of lining happening. It's time to raise the caution flag. So that's what I covered this morning. Just wanted to end it with that and go through there. So these are the indicators that I use to help me to kind of look for better trade opportunities and more importantly, stay out of trouble. Thank you all very much, and I hope you found this video useful.